Hey everyone, welcome back to Corporate Decoder, the place where we untangle the really dense stuff in the corporate world to make it easy for you to understand. And today we're looking at Golub Capital BDC. Incorporated, they just put out a prospectus supplement and it's all about their brand new notes, offering let me tell you this thing dives deep into the fine print of borrowing and what it means for the company and for investors. So get ready for a detailed look at their debt situation and what's really going on with their money Golub Capital BDC. Incorporated is offering up $250 million worth of these things called 7.050% notes due in 2028. The basic idea here is they need cash. And they're borrowing it from people like you and me by selling these notes, which are basically fancy IS when companies sell notes, they're borrowing money, and promising to pay it back later with interest. This is a really common way for businesses to get the funds they need to grow or manage their own. Operations. This filing is from September 19th, 2025, and it gives us a snapshot of their financial strategy, primarily around taking on more debt. The company isn't externally managed. It is a closed-end investment company, and for tax reasons, it has chosen to be regulated as a business development company. Essentially, they aim to make money by investing in loans to mid-sized US companies. Now let's get to the core part of this filing, the numbers, and what they actually mean for Golub Capital BDC. These notes are a further issuance of debt they are already offering, so it means they are adding to their existing debt load. They are calling these the existing notes, and the new notes they are offering will be treated as a single series, which basically means they will act like one big loan for all intents and purposes under their agreements. When they issue these new notes, the total amount of this 7.050% debt will be $700 million. That's a lot of money they are committed to paying back. The company is taking on $250 million in new debt right now, and they are selling these notes at a price higher than their face value, which is called a premium. This means they are getting more money up front than they have to pay back as principal, which sounds good, but it also means that the buyers are expecting a certain return. And this is all part of their strategy to manage their overall debt structure. They are also mentioning something called aggregate. Accrued interest of $5,434,375, which is basically interest that has built up but hasn't been paid yet and will be paid along with the principal. Later, this is a bit of a financial dance to make the numbers work smoothly on their books. The interest rate on these notes is 7.050% annually, which is quite high and tells you that investors consider this a riskier investment compared to something with a lower interest rate. For a secure government bond or a super safe company, this rate would be much lower, but since Golub Capital invests in below investment grade companies, they have to offer a higher rate to attract investors. Let's look at the company's overall debt picture as of late September 2025. They had roughly $4.9 billion of debt outstanding. This is a massive amount of money that the company owes. The breakdown is important here. $2.2 billion of it is unsecured, meaning it's not backed by specific company assets. Then there is $1.4 billion secured by assets of their subsidiaries and another $1.3 billion secured by their own assets for the notes we are talking about today. They are unsecured, meaning if the company goes bankrupt, these note holders get paid only after all the secured debt holders get their money back. That makes these notes riskier. Now, as with any investment, especially in companies that deal with loans to potentially risky businesses, there are always risks, and this filing spells them out loud, and clear the notes are unsecured, so they rank below any secured debt the company has. This means if things go really bad and there is not enough money to pay everyone back, the note holders might not get all their money back, especially if there is a lot of pledged collateral. Undersecured loans like their JPM credit facility, which currently has $1.3 billion outstanding that is effectively senior to these notes. And then there is the structural subordination issue, which sounds complicated. Basically, it means that any debt or liabilities that the company's subsidiaries have are also paid before the note holders get anything as of late September. 2025, the subsidiaries had $1.4 billion in debt that is structurally senior to these notes. So those note holders are really at the bottom of the pecking order. This is a crucial risk factor, the document that sets the rules for these notes. The indenture does not put many limits on the company's ability to take on more debt or engage in other financial maneuvers. This means they could issue more debt that ranks equally with these notes, or even issue more secured debt, which would put these note holders in an even worse position. This is a key point that Investors should really pay attention to the covenants. Do not protect investors much, in case the company gets into financial trouble beyond some basic rules about asset coverage ratios under the Investment Company Act of 1940, on which is a pretty standard rule for these kinds of companies. This phrasing is quite direct. They are admitting that this offering itself will increase their debt levels. Their current debt load could hurt their financial health and their ability to pay back their obligations. Including these notes, they have identified several negative consequences of this debt, such as making it harder to meet payments, leading to defaults limiting cash for future investments, and making them more vulnerable to economic changes. This section is basically saying we're taking on a lot of debt, and it might hurt us. That's a pretty honest statement. Looking at Golub Capital's numbers from their financial highlights, it seems overall pretty stable. Let's focus on a couple of key numbers. They report net asset value per share, which as of June 30, 2025, actual was $15. That's about on par, with prior periods suggesting stability in their underlying investments. The net investment income per share for the 9 months ended June 30, 2025 was $1.12, which is a solid income stream compared to the share price, even though it's slightly lower than the same period in the previous year. This indicates a consistent generation of income from their investments. Now, here is something that makes me raise an eyebrow. The total annual expenses are 12.27%. This is quite high in the investment world. Normally, you expect expense ratios to be much lower for a business development company. Like this, a large portion of this expense comes from interest payments on their borrowed funds as of December 30, 2024. It was 6.2% on their total debt outstanding, which is significant. Their management fees and incentive fees are also quite substantial. This high expense ratio directly eats into the returns for shareholders, and it shows how costly it is for them to operate and manage such a large amount of debt. The company's portfolio is impressive, covering a wide range of industries from healthcare to tech to consumer services. They invest heavily in what they call one-stop loans, meaning these are often complex loans that combine different types of debt, and they also hold significant equity stakes in these companies. This aggressive investment strategy creates potential for high returns, but also carries inherent risks. Common stock and preferred stock holdings also contribute to their portfolio, meaning they are not just loaning money, they are also taking equity positions, which can be more volatile. Now let's talk about the story here. Golub Capital is clearly in a growth phase. They are issuing new debt to manage their existing debt and to continue investing. This is a common strategy for BDC. But it comes with trade-offs: the high interest rates on their new notes and the substantial overall debt levels, as we saw highlight a dependence on continuous investment success and a careful management of interest rate risk. The company is betting on its ability to deploy capital effectively and generate returns that outpace their borrowing costs. The sheer number of portfolio companies listed in this report shows their diversification strategy, but also hints at the complexity of managing such a large and varied portfolio. They do have a significant amount of equity in some companies, which could offer upside, but also adds risk, especially if those companies stumble. This report indicates they are navigating a landscape of high interest rates and ongoing economic uncertainty while trying to maintain their business and expand. So what's the final take? Golub Capital BDC Incorporated appears to be a established player in the business development company space. They are actively managing a large portfolio and are utilizing debt strategically to fund their operations and investments. The high expense ratio, particularly due to interest costs, is a significant factor for potential investors to consider their expansion through new debt issuance. Indicates confidence in their investment strategy, but it also means they are exposed to market fluctuations and interest rate risks for note holders. It is crucial to understand the unsecured nature of these notes and their position relative to secured and subsidiary debt. Overall, this filing paints a picture of a company actively managing its growth and leverage in a complex financial environment. One to watch for sure. Alright, that's our deep dive into Golub Capital's debt filing. What's your opinion on this debt strategy? Do you think it's a smart move for growth or a risky gamble? Let us know in the comments below if this breakdown helped you understand these complex financial documents. Hit that like button and subscribe for more insights from the world of corporate filing. Thanks for tuning in. See you next time.